Frequency Podcast Network. Stories that matter, podcasts that resonate.
So, were you watching the financial markets this past week? Well, you probably saw the big swings and, unfortunately, losses on several occasions for the stock market. Those blaring headlines of sell-offs, and on a couple of occasions, big gains, actually, for Wall Street, all in the wake of the Trump administration's trade war. But what market professionals were watching was what was going on in the bond market, or in the U.S., the Treasury market, which saw investors dumping or simply not buying U.S. Treasuries. It was a signal of a lack of confidence in the state of the economy going forward, worries about recession and rising volatility and the chance of inflation in the U.S. economy. The problem is, that's where the U.S. government finances its debt. That led to a spike in bond yields, where the banks get their funding, influencing mortgage rates. The Canadian bond market didn't have near the volatility of the United States, but even though the Bank of Canada has cut its benchmark interest rate 7 times, with another rate announcement coming up on April 16th, this coming Wednesday, Canadian mortgage rates have only been inching lower of late, and that is going to be a challenge for the million or so Canadian households facing a mortgage renewal this year. Welcome to In This Economy. My name is Mike Eppel, and joining me to talk about what just transpired over the past week in the markets and the trends in mortgage interest rates is Victor Tran, rates.ca, mortgage and real estate expert. Victor Tran, thank you very much for joining us.
Good to be back. Thank you.
Victor, this past week, we saw volatility to the max in the stock market, but the stock market gets a lot of the attention. And you could argue that what we saw in the bond and U.S. Treasury market was actually more of a focal point for investors, because we were watching the U.S. 10-year benchmark Treasury yield spike, which seemed to be a signal to the U.S. President, Donald Trump, that things were getting a little bit unruly in the global markets, because typically U.S. Treasury yields calm down or are seen as this safe haven. That was not the case this week. But what were you watching specifically in the bond trade over the past 5 days for any signals of what the market was saying?
Yeah, Mike. I mean, it's been a wild week. I mean, we saw the 5-year government bond yield go up from 2.4% roughly since last Friday to about 2.8, and it's currently sitting around 2.8. So that's a significant jump, and that's following the tariff-related stock market mayhem that we've been witnessing as of late. You know, despite the economic damage that many countries are now saying that's underway, I mean, there's worries about the tariff-induced inflation, and it's all influenced the bond market. So the recent yield uptick that we've been seeing, it's of course related to the recent sell-off in the U.S. Treasury bonds, due to, of course, the instability introduced by the American administration, and that's influencing the global bond markets. Unfortunately, the Canadian bond market is heavily influenced by the American market as well too. So the spillover effects, it's impacting us. And it's telling the world that there's too much instability, and a lot of investors are losing confidence. So yield goes up to compensate for the lower price of bonds.
Let's delve a little bit more into that, because in the past, any time that you've seen, as you call it, instability, the first course of action has been for decades to go and buy U.S. Treasuries or buy the U.S. dollar. And in this case, it has pretty much been the exact opposite.
Exactly. Right. And investors and just people worldwide are losing confidence in the American economy. Hence the huge sell-off that we're seeing in the U.S. Treasury bonds.
And well, I mean, the argument has been this has been a self-inflicted wound.
I cannot disagree with that, Mike. You got it.
Yeah. What was it, though, about Wednesday in particular when the U.S. Treasury yield on the 10-year, or as you mentioned, the 5-year, they were all spiking overnight, and this really sent a shockwave. My Twitter or X feed was just filled with commentary overnight that was a major problem, perhaps, for the U.S. Treasury, because again, the original theory was that the Trump administration was somehow trying to maneuver yields lower so that they can refinance debt at lower levels. This has not worked out maybe the way they thought.
That's right. Yeah. I mean, this topic, it could get very complicated, right? And The thing is, the American economy and Canadian economy, we heavily rely on debt, and the bond market is where everyone should keep an eye on things to show the resiliency and the strength of the economy. So yes, when we started seeing the U.S. Treasury yields increase, that was a huge red flag to the Trump administration, and that caused a huge concern. Hence, them pausing the tariffs for 90 days. But there's theories, or conspiracy theories rather, that it was all created on purpose, right? So, I mean, that's a topic for another day. But again, people are losing confidence in the American economy right now, and unfortunately, the Canadian economy is being impacted. Mortgage rates here in Canada are starting to see a little bit of an increase as well too. I have some lenders that have already increased their fixed rates by 10 basis points. It's all reactionary to the recent rise in the bond yields. Hard to say if we're going to continue to see more rate increases by the other lenders, specifically the charter banks. I think there's a huge wait and see approach right now, especially since the Bank of Canada's next announcement on the interest rate is next Wednesday.
Let's talk a little bit more about mortgage rates, because I think the real estate market and a whole bunch of Canadian borrowers who have the mortgage reset coming up this year were hoping that we'd see rates come down, and you haven't really seen too much of that, have you?
Well, I mean, fixed rates and, of course, the variable rate have come down quite a bit in the past couple of years. It's still not low enough to make things affordable for a lot of new first-time home buyers, or even people that are buying their second home to third homes, because property values are still being sustained. Yes, values across the countries have declined a little bit since the peak of February 2022, but coupled with some of the high interest rates that we're seeing right now, for the most part, are roughly around 4% or a little bit more, is still unaffordable for most people. At the same time, confidence is just not there anymore in a lot of buyers. And with a looming recession, a lot of people are just hunkering down and just preparing for the worst. So it's just not a good time for a lot of people to take on a lot of debt. Sure, the interest rates can drop another 50 basis points or another 0.5%. And that could increase a little bit of demand. And life goes on for a lot of people. People that have the ability to buy will continue to buy. But at the same time, there's really no positive signs that things are shaping up to be good, right? There's no signs of improvement. So a lot of people are just really afraid to take on a lot of debt right now, or even spend money, especially if the recession is going to hit and people are going to be losing their jobs.
Well, we've seen that show up here in the springtime, the start of the springtime real estate market, haven't we? I mean, the March sales for Toronto were multi-decade lows, and it does indicate a lack of buyer confidence. Sellers are, depending on the sector, condos are stagnant, and I don't see that necessarily changing anytime soon over the next couple of months.
I agree with you. The condo market, especially in Toronto, it's not doing very well. And it will likely get worse as a lot more new units are going to come out on the market. The FOMO, the fear of missing out, is no longer there. It wasn't like 2021 or early 22 when people were jumping on these things. Now it's more about the fear of overpaying, right? I'll give you an example. Let's say if a first-time home buyer is relying on a minimum down payment of 5% to purchase a condo for, let's say, $500,000. 5% of a down payment is $25,000. So that's $475 to start with. That's a mortgage, but they have to pay the default insurance premium. So after adding the default insurance premium to the mortgage, that total balance starts at $494,000. Again, they bought for, let's say, $500,000. They're almost at 99% of a loan to value. By the time they close on the property, on average, most people will close within, say, 30 to 60 days out. There's a high possibility that the property value can decline and be less than what they owe on the mortgage, right? Or the value could be less than what they bought for. So right off the bat, when they take possession of the home, they can have a mortgage that's underwater already. So that's really scary to a lot of first-time home buyers. At the same time, as we've seen this recent carnage in the stock market, a lot of people's portfolios are taking a huge hit. And lots of people rely on those funds for down payments. And now they have less money to work with at the end of the day.
Does the election campaign factor in at all?
I think so. Yeah, partially. I mean, it's hard to say how much of an impact it has on buyer confidence, but certainly, right? There's thought into that. Of course, each political party has their own plan for housing, but at the same time, it's I don't think it's going to do that much, right? I mean, it's all based on individual circumstances. Of course, it really comes down to job stability as well too, and cash flow. So whether the liberals take over or continue to run the country, or the conservatives take over, I think a lot of people in the market standing on the sidelines will continue on and tread extra caution, especially.
Now, next week, we have the Bank of Canada policy announcement. And I've been watching the probabilities, I suppose, for lack of a better description, rise and fall almost by the hour on whether or not the Bank of Canada cuts rates again for an 8th meeting on Wednesday, or do they hold steady? And it really seems to be a mixed bag of should they or shouldn't they at this point? Because again, their target is about what inflation is doing. So if we see inflationary pressures moving up, then they're probably going to hold steady. What do you think that they're going to do? And at the same time, subsequently signal to the market. I mean, they're going to be talking ostensibly. Tiff Macklem, the governor of the Bank of Canada, is going to be talking an awful lot, I'm guessing, about what he sees and how the tariff fallout hits the Canadian economy.
That's right. I mean, we're 3 days away from the next Bank of Canada announcement. And yeah, it's a coin toss right now. It's hard to say if the Bank of Canada will drop the rate, likely will be 0.25%, or they can hold. I mean, March employment numbers didn't look too strong. I mean, we lost, I think, about 33,000 jobs. And that, of course, has a huge impact on Tiff Macklem's decision on whether to drop the rate or not. But like you said, I mean, things are changing daily. I mean, the foreseeable future is more like a daily thing now. And it's really hard to predict what's going to happen even on Wednesday. So I think it's going to be more of a wait and see approach. I mean, the majority of the chartered banks economists are projecting for another 0.5% decrease on average until the end of this year. So we'll likely see that. And I personally think we'll see a rate drop, if not in April, most likely June 4th, which is the next Bank of Canada announcement. But still, it's still a toss-up right now, right? We'll just have to see what happens on Monday and Tuesday, and hope for the best. I mean, the rate dropped, and of course, everyone sitting in a variable rate or holding a line of credit, they'll see some savings there. If it doesn't drop, there's really no impact on Canadians.
What are you seeing from what mortgage holders are doing right now? Are they actually locking in, or are they just going variable and waiting on the belief that rates will continue to trend lower?
There's certainly more interest in the variable rate mortgage right now, especially based on what's been happening in the market and how the Bank of Canada has been decreasing the rate quite a bit. But it really based on individual circumstances. I mean, some people prefer to just have a fixed rate, despite it being around 4 to 4.5%, just for that certainty and stability. But some people are risk takers, right? I find that my clients that have mortgages for many years now and they're coming up for renewal, they are considering the variable rate again, and they're comfortable with a little bit of risk, despite the volatility in the market. But I haven't seen anyone rush into locking in from variable to fixed. Anyone that's still holding on to a variable right now are just hanging tight and deploying the wait and see approach.
Well, Victor, give it 5 minutes. It's subject to change. So we'll see. We'll see how this each and every post, it seems like, on social media can move the markets. And certainly has been the case this week. Thank you very much for joining us.
Thanks for having me.
That was Victor Tran, rates.ca mortgage and real estate expert. You've been listening to In This Economy. My name is Mike Eppel. If you have any questions or story ideas, you can email me at mike.eppel, that's EPPEL, @rci.rogers.com. Thanks for listening.